The top business stories live from the Sky News City studio. The IMF warns the Chancellor not to consider any tax cuts in the near future. I'll be speaking with the author of an independent review into government relations with business. And HSBC has fined £57.4 million for serious failings over customer deposit protection. Good afternoon, this is Business Live with me, Ian King. The International Monetary Fund has warned the Chancellor, Jeremy Hunt, not to consider planning any tax cuts in the near future. It also expressed scepticism about the Chancellor's spending plans for the coming years. The IMF's intervention is likely to be seen as a blow to Mr Hunt, coming at the end or at the start of an election year. Well, for more on this, I'm joined now by Sky's economics editor, Ed Conway. Ed, I know I to ask you this. Why do we care about what the IMF says, given they've got such a lousy forecasting record with the UK?
Yeah, or indeed, what right have the IMF got to kind of pass judgment in this way? I mean, the short answer is they are just one of those institutions that most people, respect. They've got a lot of economists there. They have a forecasting record that is, if not amazing, it's kind of no worse than many other economists out there. And they provide this advice for many economies around the world. This was part of their latest update on the state of the global economy. So they have their World Economic Outlook. This was the latest update to it. And alongside it, they gave, I guess, unusually strong warning here about tax cuts. I mean, the point here being that the UK has quite big spending cuts forecast in the future, and the fund isn't quite sure that they're going to be able to meet them. But let's just hear from the chief economist here, because he'll just explain exactly why they're making this warning.
In the case of the UK, you might think of spending on healthcare and modernising the NHS, spending on social care, on education. You might think about critical public investment to address the climate transition, but also to boost growth. And so it's very important to have in place medium-term fiscal plans that accommodate these pressures, at the same time ensuring that debt dynamics remain stable and contained. And so that requires a combination of tax and spending measures to make sure that you can allocate the resources when they need to be allocated, but at the same time preventing your debt levels from increasing. And in that context, we would advise against further discretionary tax cuts.
Now, obviously, lots of terminology there, but buried there is quite a bombshell, because, obviously the government has said time and time again, not only have we just cut taxes, but we want to cut taxes further in the future. It is potentially the central plank of their re-election campaign this year. So to have the IMF come in and say, well, we don't think that's a good idea, it really is a big deal. The Chancellor has responded to this. He said the IMF expect growth to strengthen over the next few years, supported by our introduction of the biggest capital investment tax reliefs anywhere in the world, alongside national insurance cuts to improve work incentives. It is too early, this is in a sense more interesting, but it is too early to know whether further reductions in tax will be affordable in the budget, but we continue to believe that smart tax reductions can make a big difference in boosting growth. That's kind of interesting, isn't it? Because a lot of the nuance recently has been about, listen, we will cut taxes at the budget. I saw the Chancellor just a couple of weeks ago at the World Economic Forum in Davos, and that was definitely the hint that he was giving. So now it looks like they're kind of rowing back a bit from that. But it's very hard to see how, they don't have this big offering in the coming budget and maybe an autumn statement later in the year, depending on when the election is. And it's very awkward for them, given that the IMF has just said, well, we don't think that's a very good idea for you to do that. And given that, they could easily just say, well, who cares what the IMF has to say? A lot of people, quite reasonably, are saying that right now. However, remember, this government has set itself against the kind of attitude that we saw from Boris Johnson and Liz Truss previously. It wants to show that it's in tune with big institutions like the IMF, to show that it has credibility. So it's very difficult to kind of square that circle in the coming months, and it'll be interesting to see just how this goes down. OK, Ed, thanks for that.
Now, as the clock ticks down to the general election, Labour is looking to paint itself as a party to do business with. This afternoon, it welcomed a new report from the former Conservative advisor, Ian Anderson, which sets out what business wants to see from the next government. And Ian Anderson joins me now. Ian, welcome to you. You're a Conservative Party member for 39 years and Boris Johnson's LGBT business champion. Remind me why you switched to Labour.
Well, quite simply, Ian, because I think, like lots of other business people, I've just got absolutely tired of the spin cycle of policy and the spin cycle of people, the constantly changing priorities. We've just been hearing about the government's plans for tax cuts or not right now. I think businesses generally are absolutely tired of the chopping and changing. They want a coherent plan. They want fiscal credibility. And my report has spoken to about 350 businesses, trade unions, experts as well. They're back. And I really look to try and see a way forward and create a plan for sustainable business relations with government again.
Ian, you mentioned the changes of personnel. I mean, it's not that long ago since Labour was led by someone who wanted to nationalise great swathes of British industry. Probably a lot of his members and some MPs probably still support that. I mean, can businesses be really sure Labour has changed?
Well, look, you're absolutely right. I wouldn't have entertained doing this independent piece of work if Jeremy Corbyn was still leading the Labour Party. Keir Starmer has changed the Labour Party. If you look at his approach to business, look at Rachel Reeves' plan around fiscal discipline, you look at Johnny Reynolds' deep, day-by-day engagement with all parts of our economy, developing an industrial strategy. That's what businesses want to hear. They want to hear a coherent plan. They want a team pulling in the same direction. And actually, I think that's what they're getting from the Labour front bench. And I mean, later this week, I, along with about 600 others, large and small businesses, domestic businesses, international businesses, are going to be at this big business conference that Keir Starmer is hosting. And everyone is there because they really want to hear about that plan.
Well, one of those proposals from Labour is for a new industrial strategy council staffed by academics, business leaders, the unions. I mean, to older viewers who remember the 70s, that sounds an awful lot like NEDI, the old National Economic Development Council, which was a bit of a pointless talking shop.
Yeah, look, I mean, no one's interested in talking shops. If you read my report, I say scrap talking shops. We've got plenty of talking shops in at the moment. There are groups that, frankly, are no more than photo opportunities. No, my report is not suggesting a return to where we were in the 1960s, 1970s. And my report is talking about a new partnership, co-creation of thinking, not handed down government policies at the last moment to businesses. And actually, I've spoken to the trade unions too, and it's remarkable how similar the ambition and the current frustrations are, and the kind of words that are being used by the unions that mirror the words of business right now. I think there's a chance for a completely new partnership here.
Well, one thing that I looked for in your report and didn't find any reference to, Ian, was Brexit. I mean, it alienated an awful lot of businesses from the Conservatives, yourself included. What is Labour's stance going to be on relations with the EU?
Well, look, I mean, you'll have to ask the Labour Party that question. I've done this report independently. I'm not a member of the Labour Party, although I am backing Keir Starmer as the next Prime Minister. Look, I think what we can hope for is a much more conducive relationship with the European Union. I think that's the ambition that most businesses want to see. And I think, as with a coherent economic plan, a coherent industrial strategy, there's the chance to have a coherent conversation. And that we just haven't had lately.
What about business taxation? What did you pick up from businesses on what Labour should do on this front?
Yeah, I think, simply put, people just want to see, businesses want to see a consistent approach. I think that's tax, that's regulation. I also talk about regulation in my report, and actually getting government together with our systemic regulators to talk about the landscape for doing business in our country. All business leaders want to see is a consistent approach. Stop the chopping and changing.
All right, Ian, we have to leave it there. Good to catch up with you this afternoon. Thank you.
Thank you.
Some other business news stories for you now. And HSBC has been fined £57.4 million by the Bank of England's Prudential Regulation Authority for what are described as serious failings over customer deposit protection. It's the second highest penalty ever imposed by the financial watchdog, which the PRA said reflected the seriousness of the failings. The record remains an £87 million fine imposed on the now defunct Credit Suisse in July last year. Well, the offences, which occurred between 2015 and 2022, included a failure to accurately identify customer deposits that were eligible for protection under the Financial Services Compensation Scheme. The PRA said the lender also failed to be duly open and cooperative with it for a period of approximately 15 months, during which it failed to alert the regulator over problems identified in the incorrect marking of accounts as eligible for FSCS protection. Corporate insolvencies in England and Wales hit a 30-year high last year, according to the Insolvency Service. It said today that 25,158 firms became insolvent in 2023, meaning they ran out of money to cover debts and bills. That was up 14% on 2022, and it was the highest total since 1993. However, given the higher number of companies in the economy, the insolvency rate was only the highest since 2008. High-profile businesses which failed during the year included the retailers Wilko, Paperchase and Planet Organic and the bootmaker Hunters. United Parcel Service said today it plans to cut 12,000 jobs worldwide. The world's biggest parcel delivery and courier company said most of the jobs going would be those of full and part-time management positions and contract workers. UPS currently has about 85,000 managers as part of a global workforce of nearly 500,000 employees. The cuts, which the company hopes will save it $1 billion in costs, come after UPS lost business to rivals following strike threats from the Teamsters Union. UK mortgage approvals hit a 6-month high last month, according to Bank of England data published today. Some 50,000 home loans were approved during December. That was up from 49,300 in November. Net approvals for remortgaging, meanwhile, rose from 25,700 in November to 30,800 in December. However, for the year as a whole, the bank said that the annual growth rate for net mortgage lending was flat for the first time since it began compiling the figures this way in March 1994. Now, Diageo, the world's biggest spirits company, today reported a drop in half-year sales and profits. The owner of Johnnie Walker Scotch Whisky, Smirnoff Vodka, Don Julio Tequila and Guinness reported net sales of $10.9 billion for the 6 months to the end of December. That was down 0.6% on the same period a year earlier. Underlying operating profits, meanwhile, slipped by 5% to $3.5 billion. Well, it reflected previously highlighted issues in Latin America and the Caribbean and a drop in sales of Ciroc vodka following a dispute with the rapper Diddy, who had previously promoted the brand. Well, I've been speaking with Deborah Crew, the chief executive of Diageo. I began by asking her whether the situation in Latin America was a one-off blip.
No doubt the last 6 months has been very challenging for Diageo. And Latin America, we are seeing materially weaker performance there. It's a bit of the perfect storm. Anything that could go wrong has happened to us. We were seeing great growth in the region over the past 3 years, 50% bigger business than what we had. We were gaining share, expanding distribution, significant volume, significant premiumization. And then at the beginning of last calendar year, we saw a sharp decline. Unfortunately, there was already inventory in the market preparing for that kind of higher growth environment. And so we got stuck with a lot of extra inventory. It really is just a near-term issue. And what we announced this morning is that we look to get back to more appropriate levels for the current consumer environment by the end of this fiscal. So, should not bleed into, the business going forward.
You make a point in the statement about downtrading in the region. I mean, for many years now, Diageo's strategy has been all about premiumisation, encouraging people to trade up. Is what's happened in Latin America, does that call into question the validity of that strategy?
Look, we're still seeing premiumization broadly across the globe, but we do have pockets of downtrading, and Latin America is one of those areas. Of course, we do have a very broad portfolio, particularly on Scotch. So Scotch is really, big in Latin America. And so what you see the team pivoting to is are more standard and premium scotches versus the super premium scotch that they were selling, during that COVID super cycle. So this is one place we're seeing that downgrading. But broadly speaking, we're still seeing great premiumization across most of our markets.
Well, that was Deborah Crew from Diageo speaking to me a little earlier. The shares have had a very interesting session today. They fell by 3% first thing this morning, but they've actually closed the day up the best part of 1%. Well, speaking of the markets, coming up after this short break, we'll have a look at how the markets have done this Tuesday afternoon. Stay with us.
My very first memory of the violin is actually from my grandmother, and is when I was 3 years old. She showed me what a violin was, and it was a real discovery for me. And I think that's what sparked it. She transmitted something to me, I think, without saying much. My grandmother was living in the northeast of France with her parents, and so she played the violin, and she'd kept this little small violin, and she'd hang it on her bedroom wall. And when Germany invaded France, they wanted to try to escape to the free zone, so they tried to go to the south and ended up in a city called Perpignan. However, when you had to escape, you had to be very careful if the neighbors would know about it or people would know about it, because they could snitch on you. So my great-grandfather decided to stay in the house whilst my grandmother and her mother would escape and do as if everything was fine. So they escaped. My great-grandfather stayed. When the French police came, the milice, they actually beat him nearly to death. But he was actually still alive and managed, thankfully, to join them after. They completely sacked the house, and the incredible thing is that when they came back, a few years later, they came back to the house, it was completely empty. There was just broken things on the floor, but there was something quite magical, is that the small little violin was just in the middle of the living room, just intact. And that was the only thing that wasn't broken. And I know she didn't like talking about it because of how traumatic it was. However, I believe it's so important that we share those stories, because I think history, being told in a history book is something, but when you hear history from people who've actually lived it, it just takes a whole other dimension.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Welcome back. A little piece of breaking news that we can bring you. The CBI has said in the last few minutes that PwC, which is obviously the business services giant, has returned back to its membership. There's the tweet. We're delighted about PwC UK's return to membership and will continue to work to enjoy the confidence and backing of our members and be that unifying voice of British business. Professional services are critical to the economy and play a huge role in our sustainable growth aims. PwC, of course, one of the businesses that left the CBI temporarily after the scandals that engulfed the organisation last year. But it's back in there now, back in the CBI. Well, European stocks have given back some of their gains from earlier in the session. This is how they finished up in continental Europe. All the main indices higher, but not to the extent that they were earlier on this morning. Talking points this afternoon include Renault. That's risen by 1.25% in Paris after it abandoned plans to float its electric vehicle business, Ampere. Well, here in London, the FTSE 100 has finished up just under 0.5% higher, led by industrials and financials. The leading blue chip gainer in percentage terms is the private equity firm 3i. That's on a bit of positive broker comment. Meanwhile, WPP, the advertising and marketing services company, that's up nearly 2%. They've held a Capital Markets Day investor presentation today. Not too many fallers to mention, but the paper and packaging group Mondi has fallen by 3.25% on adverse broker comment. Outside the FTSE 100, Auction Technology Group has surged by 18% on a trading update, while Trainline is ahead 2.5%. That's after it received a push from one of the brokers. Over on Wall Street, well, the main indices opened to the downside. The S&P 500, of course, hit another record last night. A mixed bag of company results at play there. UPS, which I mentioned earlier, has fallen by 8% on its trading update. But General Motors is ahead by 6% after it beat expectations. Ford is up 1.5% in sympathy. On the foreign exchange markets, well, the pound's a bit softer on further evidence of weakening shop price inflation today. Sterling off by 0.25% or so against both the dollar and the euro, the single currency more or less unchanged against the greenback. Meanwhile, the oil price has clawed back some of its losses from earlier in the session. A barrel of Brent crude will currently set you back $82.99 a barrel. That's up a little under 0.75% on the session. Well, joining me this afternoon is Kartik Kumar, the UK Equity Manager at Artemis. Kartik, great to see you. A lot of interest in this HSBC fine earlier on this morning. Didn't really move the share price, though.
No, the HSBC fine is really quite small relative to the scale of the business and its overall market value. So if you think it's a £60 million fine relative to a business that's worth 120 billion, it's really not very significant in the broader context.
But it's quite interesting, though, given all the commentary around the investability of the banking sector just now.
Yes, and it's quite different to what's happened to Lloyds recently with the FCA's investigation into historic motor financing variable commission schemes. And there, Lloyds is down nearly 10% year to date and is trading at less than book value. But there you can see the current estimates are that it might cost the industry up to £10 billion, which is a quarter of what PPI ended up costing, but really quite a large amount of money. And I think scars are still quite fresh from how much PPI hurt the banking sector's profitability and capital.
Yeah, non-trivial sums, those. Now, we heard from Diageo earlier on in the programme. Very interesting day for the price. I mean, it opened sharply lower, but it's actually finished the session in positive territory.
Yeah, so if you look at, say, what happened to luxury stocks last Friday in Europe, in a number of these sectors that did extremely well during the pandemic, effectively there was a degree to which some trends were unsustainable and you had a pull forward in demand. And Diageo clearly had that in Latin America, where they're now suffering from destocking. So I think what you're kind of seeing is investors really trying to find out what the real base of earnings is from which you can see sustainable growth. And so you had pricing that was well above inflation during the pandemic, but then you also had this premiumization trend accelerate, and you're seeing down trading there. So the combination of those factors mean that Diageo's profits have been quite significantly below what investors would have expected a year ago. And I think it's a sort of a process of discovery to try and work out what the real base is.
Yeah, interesting point there. Now, obviously, the big events on Wall Street tonight, we'll hear from both Microsoft and from Alphabet, the parent of Google. Both, of course, big players in AI. What are you looking out for?
Well, yes, look, they're hugely significant. So Microsoft's worth $3 trillion. Google's worth nearly $2 trillion. So the two of those companies alone are worth double what the whole FTSE 100's worth. So, if they move 10%, it'd be the equivalent of the FTSE going up 20% in one day. They're very important because they're at the forefront of the development and commercialization of AI. And so really, it'll be important to see whether the strong price gains that you saw across the NASDAQ last year are justified in the financial performances of these businesses, but also it might give you an indication about what AI can do for the broader economy, because a company like Microsoft can't do well without its customers doing well.
Very briefly, Kartik, we had an announcement from the US Treasury on borrowing requirements. Is that a market-moving moment?
Yes, so if you think that because risk-free rates have been so volatile and they moved up so quickly over the last few years, the markets are really focused on inflation and debt dynamics. And so it was the debt dynamics in the US that in November really ignited the rally in risk-free rates falling. And so what you saw yesterday was some good news towards the end of business, that effectively the refunding requirement in Q1 and Q2 were below market expectations.
All right, Kartik, got to leave it there. Good to talk to you as ever this afternoon. Thanks for joining me. That's it from me. I'm back again with Business Live tomorrow morning at 11:30. Hope very much that you'll be able to join me for that. In the meantime, coming up next, it's Mark Austin with the News Hour. Thanks for joining me today. Cheerio.